Welcome to this video on simple option strategies. Strategies to look at today. Forget options for a second. Why not just buy the stock? Depending on your goal and the type of stock, this may be the best option. We will use this as a baseline to compare against the other option strategies. First, we'll look at buying a call option and when you might want to do that, and we'll call this the long call strategy. Next, the short put strategy, when we sell a put. Finally, the covered call strategy, and this involves two separate transactions, as we will see later, and is our first multi-leg strategy. So, buying a stock. Buying a stock is very simple. You choose the stock, choose a number of shares, and put in a buy order. When your order goes through, you pay the price times the number of shares, and you receive the number of shares. From that point on, your profit or loss changes as the stock price changes. This profit is unrealized until you sell the stock when it becomes realized. Contrary to an option, a stock does not have an expiration date. So in theory, you could keep it forever. Another reason to simply buy shares is that you're not limited to multiples of 100. You can buy as many shares as you want, even just a single one. Let's examine the returns for doing this. The return of the strategy is the profit you make divided by the amount it costs to set it up, which in this case is the purchase amount for the shares. Your dollar profit is going to mirror the percentage change in the stock price. If the stock goes up 10% from your purchase price, your return will be 10%. The profit of your stock positions goes up and down with the market price. When the market is below your purchase price, you have a loss, and when it is above, you have a profit. Next, we have buying a call option, which we're calling the long call option. So first and foremost, you have to choose the underlying stock. Once you know the stock, you have to choose an expiration date and a strike price. And we want to minimize the time value that we're paying for. Why is it important to minimize time value? The more time value you pay, the higher your break-even point will be. The stock price needs to increase by the time value amount just to get back to zero. One way we can do that, as we've seen in previous videos, is have a shorter expiration. Unless there's a very specific reason that you think the price will increase rapidly, it is generally better to have a longer expiration to give the stock time to increase. In this version of the long call strategy, you're looking for growth in the stock price. This leaves the strike price. Here we're going to look at different strike prices and how much they cost. The first column shows the strike purchased, $250 in this example. Then the premium paid to get it, it's $196. Then the time value, which is the premium minus the difference between the market price and the strike price. Then the break-even point. So that is basically the strike price plus the premium. Then after that, the percentage increase in the market price required to break even. So in this example, the price is at $422. To reach $446, has to go up by 5.6%. Then finally, just for fun, some examples of gain and return if the final price was $500. In this example, if it was $500, we paid our break-even $446, so we would have made $53, being 27% return. And some other ones, we're going to increase the strike price here. So we have 300. As you can see, the lower the strike, the higher the premium, but the lower the break-even, giving a better chance that the strategy will make a profit. Depending on what price the stock ends up at, the highest return on our investment will shift. But from this example, we can see that it peaks between the strikes of 250 and 300. I think 280 gives the highest in this particular example. But since we can't know what the final price will be, that's really more of an exercise. But it just shows that different strike prices will give different returns. So let's compare to just buying the stock. If it was at 500 at the end, we'd have a profit of $77 on an investment of $422. that would give us a return of about 18.3%. So that is lower than the numbers we're seeing here. The important part is that the lower the strike, the more protection against a total loss. The first line shows the percentage return for just buying the stock and has a break-even point of the stock purchase price. The second line shows the percentage return for buying the $250 strike call. You can see that the break-even point is higher, so it takes a higher price to make a profit, but also that the line increases faster than the stock line. At a certain point, the return passes the return of the stock. The third line shows the percentage return for buying the $300 strike call. Again, the break-even point is higher, and the rate of increase is also higher. It takes an even higher price to surpass the stock strategy return. Now we have the short put strategy. Again, the choice of the underlying stock is important. Just as in the bought call strategy, you may end up buying the underlying shares. Unlike the bought call strategy, you don't have full control over whether that happens or not, because the person who owns the put gets to decide that. In this strategy, you're really selling time value, so you want to maximize it. You can sell a put with the intention of buying the shares for a lower price, but in this case, you're hoping that the option will expire worthless and you can keep the entire premium as profit. Choosing the strike price, you want a strike price that has the correct balance between giving the stock price some room to drop and receiving a reasonable amount of time value. And this is best done by choosing a strike price that is below the market price by a certain percentage. And that will just come with experience. And also, this means that the premium is entirely composed of time value. Then, choosing the expiration date. This is meant to be a repeating strategy for as long as conditions allow it, which means that you can get a reasonable amount of time value. So you want to choose an expiration date that will give you the most money when repeated multiple times. And a way to look at this is how much time value do you receive per day? This graph shows the time value of a put divided by the number of days until expiration. This gives the amount of time value per day. You can see that the value increases as the expiration increases, but that it reaches a peak. This is the expiration that you want to sell. If you can repeat this, you will make the most profit from this strategy. This is a reminder of the profit profile for the sold put strategy. You keep the full premium as profit as long as the stock price stays above the strike price. Below the strike price, you will have to take action or purchase the shares at the strike price. One action is to buy the put back and close out the position. This can still be profitable if the premium is less than what you received. You can also sell another put option to keep the strategy going. Finally, we have the covered call strategy. A covered call is the combination of owning 100 shares of a stock and selling a call on those same shares. It is called covered because you won't have to go buy the shares if the call is exercised against you. You already have them and therefore are covered. You may have already had the shares, or you may have bought them just for this strategy. You can enter the strategy all at once with what is called a buy right order. This buys 100 shares and at the same time sells one call option. And this can be done for any multiple of 100. The number of calls will always be the number of shares divided by 100. The nice thing about doing it all at once in a single order is that both things will happen at the same time. You won't end up with just the shares or just the call. So this strategy is similar to simply owning the shares, in that if the share price decreases, so does the value of the strategy. The difference is that by selling the call, you limit the upside when the share price increases. In the same way that you want a long expiration for a bought call, you typically want a shorter expiration for a sold call in a covered call strategy. One reason for this is that you don't want to allow too much time for the stock price to increase. Another reason is that this strategy works best when it is repeated, meaning that over time you will sell many calls against the shares, keeping the premium each time. Every time this happens, you realize the profit of keeping the premium and potentially have an unrealized profit on an increase in the price of the shares. Another upside is that you can make a profit if the share price stays the same or even declines slightly. To get the profit profile of the covered call, you need to add the profiles of the individual legs together. First, owning the stock. You've seen this line before. Then the sold call. Adding both of these lines together gives you the profit profile for the strategy as a whole. You may notice that the graph profile looks just like the graph for a sold put, and you would be right. These two strategies have the same profit profile. The covered call line is shifted up, meaning that it is profitable at a lower market price. This is because of the added profit from the difference between the purchase price and stock price. This allows you to switch between the two strategies in case you are assigned in one of them. If your shares are called away, you can start selling puts. If your put is assigned, you may be able to sell covered calls on them. There are also ways to handle the case when the share price passes your strike price. I'll discuss that in a more general video about rolling option positions. Again, thanks for listening.